Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we going to talk about? Well, I want to talk about the elephant in the room, which is obviously this market slide we're going through, and I have a lot of thoughts on that. I'll talk a little bit about the methodology in action, and I figured it'd be very important for me to talk about where are we now. Now, obviously, the charts are going to change over time, but longer term, the concepts will still be there, and I think it's important to show you those concepts. By the way, housekeeping, I do take requests. It makes my job a lot easier. Tell me what you're interested in, and I'll work to cover it. And if I can't fit it all into this venue, I do a show on Thursday nights at 6 o'clock p.m. Central Time, and it's a little bit more open format, and I could take a little bit more time, and we could go a little deeper, possibly, if you'd like, on requests. If you need to reach me, DaveLandry.com/contact. If you would like the slides from this presentation and every other presentation that I've ever done, and I think we're closing in on 100 shows. We might have a little celebration here soon. I was just talking with my producer, Rachel. Anyway, lots and lots of stuff to keep you busy for a long, long time, including all three of my books in PDF format. All right, let's talk about the mystery chart and the methodology in action. So we actually have a long coming into today, or potential long, I should say. It was in a kind of a gradual uptrend, but kind of bumping its way higher, as you can see. And then it began to accelerate higher. And of course, the big blue arrows also pointing higher. And then it has begun to pull back. A couple things in here too. Notice that the trend right here is a very persistent one, and it's also accelerating. So it's a combination of a couple of patterns, and of course it's a pullback. But it's a persistent pullback, and it's also what I call accelerating momentum strategy, where a stock just kind of works its way higher in a fairly gradual manner and then begins to accelerate higher, and then a nice little retracement in here. So we'll keep an eye on this one in upcoming shows. Now, I think now's the time to think about what to do when the SHTF. Now, first thing, don't panic. Breathe. Try to take a 30,000 foot view of everything, and I'll show you a few things to do with that in just a few minutes. Try not to look at your eroding equity. I know, haha, it's like you lose more in one day than you made in possibly months, and it's tough, believe me. Now, you have to do a little triage. What stocks have exceeded your stops, and what are you going to do with those? And which ones are a long ways away from stopping out? So let's say you've got on 10 positions, and let's say 6 or 7 of them, the market would really have to implode to take you out. There's nothing to do with those. Yeah, it sucks, to put it mildly, but there's nothing for you to do other than ride out the correction. I'll show you why in just one second. The other thing to ask yourself, and this is really hard, this is where you have to breathe a little bit and again take a 30,000 foot view. You have to ask yourself, is there an opportunity in this? And remember, volatility is our friend as momentum traders and as traders in general. So as far as an opportunity on big gaps down, it's too late to hedge. And by the way, hedging in theory sounds great. In reality, it is not. And just kind of in a nutshell, hedges cost money, and they're a constant erosion, so to speak, to your equity. And then when they finally do work, it's like, well, you're still losing the money, and the hedge is making a little money. And it just, net overall, it's just a constant drain. So I've talked about this in a lot more detail in prior presentations. So I'd encourage you to go in and watch some of those, specifically in the weekend charts. Now, anyway, if the market does gap down, it's too late to hedge, but you need to ask yourself, is it a route where a short futures or index shares or inverse ETFs should be taken? Now, the downside to that, and that's something I was a little concerned about getting into today, but the downside of doing that is sometimes you end up adding insult to injury. You get into an inverse ETF or you short the futures, and that position doesn't work. You lose money on that, and then you also lose money on your long stocks. And it could be very frustrating, and again, it could add insult to injury. Now, the other thing to ask yourself is there the possibility of the mother of all opening gap reversals. Well, I actually was excited yesterday. It's kind of like I had mixed emotions coming into the big market slide. I'm kind of like, ooh, big market slide. There's going to be some great opportunities. Like, oh, big market slide. I'm going to get crushed on my positions. And I'll show you the opening gap reversal in just 1 second. So again, make no bones about it. It sucks. Now, momentum trading often ends badly, but it's what you signed up for. And by the way, the only way to make money trading is to capture a trend. So you have to remind yourself it's where the money is. And again, the only way to make real money is through capturing longer term trends. We had one stopped out not that long ago for a 500% gain. You catch one of those a year and you had a pretty good year. Now, the reason trend following works, and it's a bit of a paradox, is because sometimes it don't. If it always worked, then everybody would agree on the markets, and eventually the markets wouldn't trend at all. But the fact that markets do trend and do have these little shakeout moves every now and then, and sometimes turn into the opposite trend, a bear market, is the reason why trend following works longer term. Now, let's take a look at a little bit of the triage. Here's a stock that I had to exit yesterday. And this is one, and fortunately I didn't have a big position because it was something that I was sort of ho-hum on, and I guess thinking out loud, maybe you shouldn't take a position if you're ho-hum on it. But anyway, it was an IPO breakout. So I bought it on that day there. It looks like September 7th. And my stop was around 25.5. And as you can see, the market dipped below it, so I was stopped out. Now, notice that it didn't go too far below that stop. It reversed and went straight back up. And of course, I dropped an F-bomb. So it happens, spelled with a silent SH. Now, let's say that we came into this position and we had a gap way down here, okay? And the market began to rally off of that gap. Well, even though the gap is below where your stop is, well below your stop, where your stop is, since the bomb is already blown up, so to speak, the damage is already there, then the best thing you could do is improve upon the situation. Now, if the gap's down and keeps on dropping, you just have to get out, no questions asked. But if it begins to reverse, sometimes you can put a stop in right below that low, and that's what I call an opening gap reversal, or as my clients now call them, ogres. Now, getting back to the triage, you also have to ask yourself, what has to be kept? Everything in whites in this portfolio has been exited for a swing trade. Notice that the numbers aren't phenomenal for the whites, and usually about $1,000 because we're looking for a 1% gain. And the real money is, again, in the longer term trend following. Now, we don't have any 500% gainers in here like we did a while back, but we've got some decent trades in here. There's one that's 68%. Now, you're not going to get 68% or 70% or 500% with a really tight stop. So that stop is allowed to gradually loosen over time. And you can see in this particular case here, we're up 157%. But notice the current price, $43, is well above the stop. So that's going to be a pretty big hit when, not if, the stop is hit. But hopefully, a word you should never use in this business, but hopefully it'll continue to trend higher. And if it does, that stop will be at a much higher level. And that'll make sense in just 1 second. So here's another one. We're up 90%, but you can see that stop is a long ways away from where the market is. So the great thing about me doing this trading service is I come in and I look at all the positions and I say, okay, this sucks, again, to put it mildly, but my stops are a long, long, long ways away. I got stopped on in a few personal positions, personal meaning that they're outside of my trading service, such as that NE and some IPOs and that type of thing. But everything in the service, knock on wood, didn't stop out yesterday. Now, here's the point I want to make as far as longer-term trend following. So we bought way back here. This is Academy Sports, ASO. We sold half for a swing trade, and then we trailed the stop higher on the remainder. And again, we let that open up gradually over time. And as you can see now, it's a long, long ways away from the market. And yes, it's going to be painful when that stop is hit, but hopefully This will just be another correction, like we had a correction here, and then we had a bit of a sideways correction. Market took off again with a little sideways, and then we had a couple of corrections. And then we had the mother of all corrections. And it's tough when it's down here around 30-something and your stop is right here. You're thinking, why am I even bothering? I don't want to lose another point, and you're probably going to be inclined to get out. What it forces me to do, and you could do the same exact thing at home, just make sure you have a trading plan and then follow your plan, especially when it comes to this triage, so to speak. But anyway, so far, so good. And on a day like that, that's what I call a knockout move, even though it's painful. And by the end of the day, in the plus column, you didn't know that, though. You didn't know it would. But those are the type of moves that shake people out. And those people are forced to get back in at higher levels, and that helps the trend to continue. It also sucks in some eager shorts, and they get punished, as we talked about before with the TKOs. And so you could see yesterday's move, not too ugly in ASO, and so far it's just kind of pulling back. Now, let's say you did get stopped out. Well, we got in way back last November or so, and we rode it all the way from the high teens all the way up to 35 and change. So that's about a 100% move, and that's better than a poke in the eye. I did math on that. If you were stopped out, you would make $7,000 round numbers, and this is on a hypothetical 100K account, although I do take these actual trades myself, and that would be about a 113% gain. And again, 7% on your entire account, that's nothing to sneeze at. You catch a few of these a year, or one 500% move, which I think in the end was about a 25% move overall. You catch one or two of those a year, and you're going to be doing pretty good. Now, if it stresses you out to lose that money in the end, and as I often say, all trend trades eventually end badly, then just send me the money. You know, as I often joke, keep enough out to get you a little massage so you could forget about the entire trade and send me the money. P.O. Box 298, Abita Springs, Louisiana, 70420. And in 30 years, God, Lord, I'm getting old. In 30 years of doing this, nobody's ever sent me a check because they were aggravated for making money. Now, the thing you also have to ask yourself is, are there any opportunities? Now, as alluded to earlier, the opening gap reversal, it's not only a damage control situation, but it's a situation where you could possibly go in and make a little money. Now, yesterday, the market really didn't get off its butt for a while, so there weren't really any opening gap reversal situations that were worth trading. But sometimes you've got a stock that pulls back kind of nicely, then it has a big gap down, shakes out a lot of people, and then turns right back up. And when that occurs, you can enter on a breakout of that morning range and then put in a stop below the low and then trail your stop higher during the day and exit by the close. Now, this isn't hedging, and you have to be really careful. And I was a little hesitant to show you this screen, but I figured it'd be good to give you a little insight into what I occasionally do. And this is S&P futures. And I would be really careful, and I guess the word I'm trying to look for is tread lightly when it comes to futures, because they're very tough to trade. I had a client a while back, as I've said quite a bit, and he wanted to get into E-mini trading, and he thought I was being a little aloof or a little elusive with him, and it wasn't that. It's just that it's a very difficult market to trade. But I came in pre-market really early, and it looked like the market wasn't going to stop. So I shorted it, and I put in a trailing stop and got stopped out for a small gain. And then it looked like the mother of all reversals, the opening gap reversal I talked about from a very oversold market. So I got long and then got stopped out, and then got short, caught a pretty good trend, covered half here, and then covered the rest down here. And then toward the end of the day, I did what's called the race to the finish. Sometimes, especially if a market is very oversold and has sold off hard like the S&Ps did yesterday, you'll get a bit of a vacuum to the upside going into the close. So the last few minutes of the day, I went long. And had I not gotten beaten up so bad, I might have held them a little bit longer, maybe into the after-hours session. And they had a really good rally into the after-hours. But I decided, you know what, let me just get out at the close and then at least make a little bit on the trade. So again, this trade did okay. This trade turned into a losing trade. And then this one did pretty good. And the next one did okay going into close. And I just exited again just so I would not have to deal with after hours trading. So that one was, I'd say, good. About 20 points. And 20 points is a good number to catch in the P's. Now let's talk about market timing. And what's kind of ironic in all this, don't you think, is my presentation. I did a presentation about 2 weeks ago on before the bomb blows up. And the reasoning behind that was friends and relatives come out of the woodwork whenever the market begins to tank. And usually they don't call me until the market's down about 30% and they ask me what to do, which puts me into a lose-lose situation. So I said, you know what? Market is at or near new highs. Let me do a presentation on market timing. And if they care to, they can go out and watch that presentation. I think it's good for everyone else too to brush up on your market timing. And I don't want to go all Sun Tzu on you, but it's kind of like in times of peace, prepare for war. Oh, fun fact. Speaking of Chinese generals, General So was allergic to chicken. Isn't that ironic? But anyway, my presentation was about a week before the market topped out, as you can see. And hopefully, and I know you should never use that word hope, but hopefully we're just in a little bit of a corrective phase. So let's talk about where we are now, not from a standpoint of, hey, here's the charts, check back often, but from a standpoint of, let's take a look at some of these concepts, and if I get hit by a beer truck, you could take these concepts and use them in future markets. Now, I'm using my ACP plugin, and if you want to get the plugin, all you have to do is like the video, and then come down here, this little plugin, and it'll be available to you. So in this case, we have what I call the buy line, which is simply 10% below the 50-week closing high. This is a weekly chart, by the way. And this is a 50-week moving average. And I'm not going to get into a lot of details on the system because we discussed it a few weeks back, and you can go in and watch that presentation. But essentially, you want to get out of the way, sell when you have a close below the buy line and the 50-week moving average. And you want to get back in when you have 2 days of Landry light with the 50-week moving average and you're above the buy line. And you want to stay long as you're above that buy line. So what I found really interesting is even with that little bit of an ugly slide, or a lot of bit of an ugly slide we had yesterday, we're still a long ways away from the buy line. Now the buy line is 10% below the 50-week closing high. So right there, there's your 50-week closing high. And then you can see the buy line is way down here at 40.80. So again, in case I get hit by a beer truck, now you know. If we drop below this green line and this red line, okay, if we close below the green line and the red line, you need to get out of the market. Now, a couple things I want to show you that are pretty cool. By the way, the goal with this system was to avoid what I call the diaper change moment, and that's a term I stole from Ian McActivey. And he used to give the best presentations in the world. I wish I could channel him in some of my presentations and give presentations like he did. He could make market statistics funny, if you can imagine that. But anyway, and charts. Anyway, Ian talked about the diaper change moment. So a diaper change moment would be like, okay, you're in the market here, and then all of a sudden you're in the market way down here. Forget about this little reversal for a second. So that's 30-something percent, 40%. You're a hurting pup at that point in time. You can see here's the little percent from high, so right around 35% or so at this peak. And that's the diaper change moment. Now I'm going to show you a spreadsheet real quick. I know you want to party with me, right? Where I show the diaper change moments from the exit. So from this exit down to here, I'll show that. Anyway, so that's what you want to avoid when it comes to market timing, is the big slides. And it's more about, it's not as much about beating the market as it is about not letting the market beat you, okay? So let's say you're going into retirement right around this day here, a pandemic hits, all of a sudden you have 40% less money, and you're faced with some really tough decisions. Do you get out? Okay, well, the bomb's already blown up. Is it too late? It might not be, because the market could still go another 30 or 40% or more, believe it or not. But anyway, if you have some sort of timing in place, at least you have an idea where you are with the market. So that's the TFM 10% system. Where we are now, we're still long. We've been long since way back here, since July of last year. So it's been a pretty good run. Now, one thing that's kind of interesting, and my favorite moving average, at least in the last couple of years, is a 30 EMA. And Landry Light is down here, and this is just the highs, the lows are greater than the moving average for uptrends, and it's green, and this just counts the number of bars, okay? And then if the highs are less than the moving average, then it turns red. So you can see in this entire trend, going all the way back to last year, we only had a couple of days of red. So it's been mostly green the whole time. And then obviously in this last little slide, we've had 2 days of red so far, unless we have the mother of all reversals today. Then we just had 1 day. But you can see high less than the EMA. So that gives you downside Landry Light. Now, I thought it'd be cool, and again, you probably want to party with me, to put in the well-watched 50-day EMA. And to my surprise, you can go all the way back to last November. And notice all the green down here. And this should get you excited, okay, about market timing and just simple ways to stay on the right side of the trend. But you can see that we had Landry Light, a little kiss of the moving average, and sometimes that could actually be a buying opportunity if the trend begins to resume. I have a pattern based solely on that, and that's called the Landry Light pullbacks, and I use those mostly with a 30 EMA. But what's pretty amazing here, again, is you can go all the way back to last fall, and this entire trend up until when? Last 2 days was contained by the 50-day simple moving average. Now, the 50-day simple, by the way, is very well watched. That and also the 200. And I don't pay a lot of attention. You probably never hear me talk about it until and unless the market nears it, as we did yesterday and the day before, okay? But now we have, you can see, 1 high below, 2 highs below. This is the daily chart, 50-day moving average. Notice right here, -2. So now the count is -2. Not the end of the world, nor can you see it from here, but it's something that you might want to pay attention to. If we continue to have Landry Light, pick your favorite moving average, but below that moving average, then you should be concerned. Now, here's something else that I thought was really cool, is I applied the 200-day moving average. Now, it might be a little dangerous to just trade off the 200-day moving average, but one thing that's kind of cool about it is you can go all the way back to last June, and we had pretty much Landry Light ever since. And then also, notice when you cross below it, back in February, that's when we had that big slide to the downside when the market really started to take the pandemic seriously. Now, obviously, if you were trading some sort of simple system like this, it would take a long time to get back up to that moving average, but as a general statement, you could see how it could help to keep you out of slides. And by the way, one thing I wanted to show you last week is, say you have some sort of premise like this, and this is kind of cool in ACP. You can say, okay, we're going to stay long as we have upside Landry Light. So you can come in here and say, okay, so we're long from about 1200, and you could just do like a little walk forward test like I'm doing now. And this is the best way, by the way, if you have a theory in your head you want to test, to get a feel for how it works. And just, you can see that, okay, well, that got us long way back then. Oh, now we'd be out. Okay, well, you made a little bit on a trade, but not a whole lot. And then just keep doing this. And again, do this walk forward type of testing. Come up with whatever theory you're thinking about, and then work with it. The only thing I would caution you is don't holy grail hunt too much, because there is no holy grail. But I hate to tell you not to look, because sometimes in the looking is where you learn how to trade markets. Now let's switch back to the slides, and I want to rehash a few things on the market timing. as I said a couple of weeks ago, market timing is less about beating the market and more about not letting the market beat you. So again, avoiding the occasional 50% haircut is key. And again, if you're getting ready to retire and you lose half of your money, unless you've got, let's say, $10 million, you're going to really be hurt and pop. If you have $1 million and then you're down to $500,000, your life is going to change drastically. I have a friend of mine, and he's really looking forward to retiring as soon as possible. And that pandemic really threw him for a loop. And of course, he calls it when he's down 35%. As we often say, as I learned way back when I was involved with the hedge fund, or hedge funds, he who fights and runs away lives to fight another day. So it's okay to get out of the market if you have a signal. Now, one thing you need to really focus on, again, and this is where you come back to not beating the market so much, but not letting the market beat you, is the downside magnitude versus the mechanical systems in and of themselves. If you were trading the TFM 10% system, you would have gotten out right before that huge panic that we had with the pandemic slide. Of course, you would have lost at least 10% going down to the 10% line, but then your losses would have stopped, and I'll show you in a spreadsheet how much uglier they would have been. So, unfortunately, you would have gotten back in right about the same level. Well, Greg Morris once said that whipsaws are frustrating, bear markets are devastating. You could survive frustration. So I showed the slide a few weeks back. So here's points in time where this system would have exited, and this is the slide after the exit. So you can see the exit on February 27th. The market lost another 28% of its value. So let's just do that in round numbers. That's 30%. If you lose 30% of your money, that's a lot of money to lose. Now, the buy and hope people who drink the Kool-Aid will tell you that, well, the market always comes back. Well, not always. And sometimes it could take 25 years or more, and I've done plenty of presentations on that. Also, what I would encourage you to do, and you can get it for free with that aforementioned link, and I'll pull it up in 1 second, is read the Layman's Guide to Trading Stocks, where I talked about how the market can take a long, long, long time to come back. Just real quick, every major bull or bear market will have a signal. Go in and watch again the market timing show. Not every signal will lead to a bull or bear market, but as Greg Morris used to say many years ago, but he's running $5 billion or however many billions, they treated every signal as if it would become the big one, Elizabeth implied. Again, he who fights and runs away lives to fight another day. You need to be longer term in your market timing, but shorter term in your trading. What does that mean? Well, let's say I've got 10 stocks open, which I think I do right now, and I start getting stopped out of my stocks. Well, I just have to take the loss and lick my wounds. So you don't necessarily want to exit everything because you never know. One of those stocks might take off. So maybe, and just maybe, you take a look at this presentation and let's say a year from now, and we might still be in those same signals, same setups. So you want to listen to the database. If you're seeing a lot of shorts showing up, you might want to start shorting and pulling your horns a little bit. And again, allow yourself to get stopped out. Well, that's all my time for this week. I want to thank everyone for watching. If you need some follow-up information, DaveLandry.com/StockCharts. And if you reach me, DaveLandry.com/contact. Thanks again for watching, and may the trend be with you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.